We're looking now at the AIM market, which has traditionally been small growth companies, but there's an opportunity as well to look in this particular part of the cycle at income coming through from dividend payments from this particular sector. It's not often looked at, but we're now talking to a portfolio manager who specialises in IGT portfolio management. It's Chris Boxall from Fundamental Asset Management. Chris, welcome.
Hello, thank you.
We've spoken a lot about AIM stocks over the years, and this market has moved a lot, as we'll see in the next few moments or so. But this idea about going to AIM for dividend is not what some would regard as the reason for investing in the AIM market.
No, it's a very good point. I mean, AIM is a growth market and it's not known for its big dividend income payers or big dividend payers. But, you've seen share prices come off a lot. AIM's matured a lot. There are a lot of really good, mature, well-established companies and who like paying out big dividends and whose shareholders, some of whom are insiders, family owners as well, want big dividend payouts, or they expect it. So you've now seen a more mature AIM, which actually offers some quite interesting dividend income and better than was in the past, a lot better than when we looked at this 10 years or so years ago, first of all.
You alerted me to the Link Monitor report. I think we've got a graphic showing what this tells us. And if we look at this, we can see that there's some big numbers here. I mean, as you say, this is a market which is becoming mature, and we're now talking about some really big figures.
Yeah, I mean, broadly, Link is estimating or predicting that dividend payout is going to hit about 1.2 billion for this year. So a lot of companies paused their dividends during the pandemic and now said they've reinstated them. I think you've seen the biggest acceleration in the construction materials sector. So a lot of those companies now reinstated dividends. They're quite attractive payouts. So 1.2 billion on a circa 90, just shy of 100 billion value. So overall, in AIM its entirety, that gives you an approximate yield for all of the companies, just 1 and a bit %. It clearly isn't great, but within there, you've got some very big dividend payers as well.
Give an example then about the numbers of companies we're talking about and the sort of figures.
Well, you've got approximately, we estimate there are quite a few companies now in AIM yielding more than 5%. And some of them are yielding as much as 10%, 11%. Clearly, you've got to look carefully at these businesses to see if the dividends are sustainable. But even companies yielding, more than 3%, we estimate there are 86 stocks yielding more than 3% with a value of 18 billion. Go down to things that are a lot higher yielding, that's the 5%ers plus. And you've got still a value of about 8 billion in market cap of companies that are yielding those sort of numbers. And I say you've got some quite big companies actually offering some quite attractive yields. I think it's a good point there as well to emphasize. Many years ago, some of these high yielders would have been much smaller companies, very distressed. Many of these businesses are not seemingly distressed. Literally, it's a matter of their shares having fallen precipitously over the course of 2022. Perhaps now offering a decent catalyst to take for share investors to take a closer look at them.
What do you look at in terms of some of the points to watch out for? Why are valuations so attractive? What is it that's behind all this?
Well, first of all, these are well-established businesses. I'm not looking for newer businesses that don't have a good track record of dividend payouts. So these are well-established companies, profitable, cash generative, and the cash generation and cash cover of dividends is key. Sometimes investors need to look beyond earnings cover because earnings are typically adjusted a lot. So you have to look at realistically what the cash cover is. Shares have been underperforming. You've seen a lot of things sell off, some very irrationally. If a company disappoints on AIM over the course of 22, you could have seen a huge sell off, maybe significantly overdone. And a lot of these businesses they all call themselves growth companies. I think one in particular we're going to draw attention to. It's far removed from being a yield play. Its management will probably be, concerned that we're talking about it for its dividend attraction because it very much is a growth story. And AIM is a growth market. So you maybe can get a little bit of benefit of both. You get some growth and some income from these stocks.
It could be argued, of course, that the sell-off has happened because it's justified, given the part of the economic cycle. We've got rising interest rates. To what degree is there an opportunity here, do you think, for stocks that might benefit from rising interest rates?
A few of them a lot of them in the financial services sector are actually beneficiaries of rising interest rates. Typically those businesses that need to maintain a very high cash buffer, or if, for argument's brokers that are earning interest on cash, clearly are beneficiaries. You know, they've been earning diddly squat for many years, and now they're getting 2-3% on their fixed cash, and that adds a lot to the bottom line. So you are seeing some interest rate winners in here as well, and as well some losers. Clearly that is the case. But I think a lot of the ones we're going to talk about are companies that have a decent cash buffer and a decent cash position.
But there's a risk to all this, isn't there? I mean, I know you're going to show us a chart where there's some stresses and strains, but certainly dividends could come under pressure. I mean, as I say, going back to this idea of where we are in the economic cycle, and we're already told that this economy in the UK, at least, is in recession. Doesn't feel like it, I must admit. Yeah. For anybody that follows the markets, you know, you still see retail sales rising and so forth. But that aside, there's clearly going to be some stresses in this sector.
There are, and you have to be careful. You have to look to see if these dividends are affordable. Some companies conceivably are probably paying out too much. We always a little bit skeptical when a company pays out too much. When it's a so-called growth business delivering high returns on equity, why is it paying out such higher dividend? Hasn't it got anything better to do with its cash? It should have, really. So you have to balance that out. And some, going back to that issue of dividend cover, you have to see if that's reasonable. If a business is carrying too much debt as well, clearly the cost of that debt is going to go up. So there could be some stresses and strains in there. I think we've had one company that I would be more sceptical about at the moment.
Is that Strix Group? Because I know you've asked me to bring up a chart for Strix. So let's take a look at what's happened here. I think this just goes to show, I mean, that when you're in this situation, some people look at this chart and think, there's an opportunity here. But there's also those that will say, well, you're catching a falling knife. Unless you know about the fundamentals, of course. What is it about this company that has alerted you to this and want to bring it up as a chart?
Strix has a terrific position in kettle controls, safety controls for kettles and other hot water boiling products. It's tried to recycle this very strong cash generation into acquiring other businesses in the water arena, water filtration technologies. However, it's also tried to keep paying out a big dividend, and it's also run a very high debt, or relatively high level of debt. Now suddenly it made a big deal, it made a big acquisition, so maintaining all those three strands becomes quite tricky. And we haven't heard yet if the dividend's going to suffer. I would suggest that the market thinks the dividend is at risk now, given the way the shares have fallen following a recent profit warning, that things were a bit tougher. It manufactures a lot of things out in China. Clearly there have been big concerns with COVID controls out of lockdowns in China. That's impacted its manufacturing. So Strix's dividend yield, I think it's circa 7-8%, something like that at the moment. Its forecast yield perhaps is at risk. Again, you need to do a lot of work into this stock to see where the strains are. It's often unwise to look at a yield of a business that's carrying a very high debt load, in my opinion. It should be perhaps servicing its debt, particularly if the cost of that's going to go up. So Strix has got some strains in there.
Well, let's take what you said and overlay those sort of ideas onto some other stocks that you want to talk about. And one of them is Gately Holdings.
Yeah, Gately Holdings, it's a very interesting business. It was the first commercial law firm to list on the stock market. And it's still, its core shareholder base are effectively partners. And these partners clearly are using the market listing to exit. And they also probably like a dividend as well. So Gately has committed to paying out 70% of its post-tax profits as dividends. So you've had this committed dividend yield. It's also been growing. Perhaps earnings have been pretty lackluster, the growth, compared to others, but it's been pretty steady. It's also trying to recycle cash into non-legal services. So it's trying to build up this professional services bit. Probably the risk with Gately is that circa 45% of its activities are property-related legal services. So if the property sector suffers, how will it impact Gately? But it has, as I say, been looking into other areas. So it's more diversified than it was a few years ago. But yeah, an interesting business where where the core shareholder base clearly wants its dividend, management's committed to it, and there are a lot of growth initiatives going on. So we like it. Circa 220 odd million market cap, possible to buy and sell the shares. It's not a diddly squat AIM company. It's important, I think, to avoid those. We're going to talk about businesses where the shares are liquid, where you can actually have a chance of buying and selling them.
Let's take a look at the second one, MP Evans Group. I'm not sure we've spoken about this before, and it's in a sector that is discussed at the moment, isn't it?
Discussed a lot. A sensitive sector, palm oil. It's been around a long, long time. It's a very elderly name on the stock market, and as a company, I think it dates back to the 1870s. It used to have plantations. It even used to have beef cattle exposure in Australia, but those are all gone. I think it's really exclusively Indonesian palm oil. It's making a big push to sustainability. It's very focused on that, and that's the message it's trying to spread. But it's had a terrific run over the last, this year. Palm oil prices shot up, so it is very much a play on the palm oil price and improving output as well from its plantations. But your yield on that circa 5%. I think I forgot to mention Gately. I think the yield on that's about 5% and a bit as well. So an interesting business play on palm oil, 450 to circa 500 million pound business, quite big, very well established, commitment to paying out dividend. I think it's rarely missed a dividend payment in its stock market life. So quite attractive, 30 plus years. So very different, as you've alluded to, a bit sensitive, the area of palm oil.
And of course, we mustn't forget, I should say, that this 5% dividend sounds a lot, but we've got to consider the fact that we've got inflation at 10.12%, whatever it is at the moment. So even at these levels, it is good to get that sort of return. You're never going to get that in the cash markets, for example.
Absolutely. Clearly, you're at risk of the stock market, the share price coming back. But MP Evans is a consistent performer. Is its time now? I don't know. Palm oil, though, interesting.
It was the 5% thing I was most interested in. Another 5% yielder you've got here is K3 Capital Group. Going back to the list of companies we've spoken about before, this is one of those that we've spoken about, and you have highlighted this as an opportunity. And to be fair, you have, in the past, done very well out of this stock. And indeed, it's on the rise again. Again, another 5.2% yielder.
Yeah, it's interesting. Is this dividend too high? It's an odd one. This is a growth stock, and I think management wouldn't, as I mentioned, probably wouldn't be that happy about us talking about it as a yield stock. They probably don't think we're
an income play.
Yeah, an income play. But it is still growing strongly. Its core business was in the area of business sales, sort of corporate financing, but business sales, buying and selling SMEs. But it's been using its cash generation and coming back to the market for more equity to support acquisitions. So it's also bought an insolvency business. It's bought a business as well that does R&D tax credits applications. So it's got these other strings to its bow now. Quite interesting. And bizarrely, it pays out quite a lot of quite a big dividend. But at the same time, also coming back to the market for more equity, which I can't get my head around. I don't think Mr. Buffett will be that impressed with its capital allocation policy. But for those that want a divvy, it's very, very cash generative, and margins are great. It's circa 20% plus operating margin. So it ticks a lot of boxes, high return on equity as well. And it's got that growth driver. So potentially a stock where you get a little bit of both out. You get a dividend to support the patient, but you've also got a highly ambitious management team as well that really want to move it up a gear.
Yeah. Your last choice is Premier Miton. I know this is an asset management company.
Yeah, absolutely.
Been doing very well. And it yields 9%. Now, that is closer to this striking break even with inflation.
It is. Some might be concerned that the dividend here is too high. The dividend hasn't grown either. It announced results recently, which were pretty good. It manages circa just shy of 11 billion. Revenues were about, I think the market cap, is about 160 odd million. So it's valued at only about 1.6% of its assets under management. The worry with this is, are its asset management activities the sort of activities that its advisors want to buy into? It's very much an active asset manager, which is a generalist active asset manager, which is under pressure from the passive investment brigade. So it's managing a lot of active funds, not much of a differentiator. Well, the worry could be that. but its results were pretty good. It's been trying to invest in other areas as well. It's pushing ahead with its so-called model portfolio service, which IFAs like, advisors like. And its, I think, performance has been reasonably good, but it has seen assets, come out. So it's had withdrawals, not just down to declining equity markets, but yeah, it's committed to its dividend, terrific margin, loads of cash. I think over a quarter of the business is in cash. It's got 40 odd million pounds in cash, which is quite an interesting buffer. But there was no growth. I mean, a lot of people looked for dividend growth as well, and there's no dividend growth here. It just maintained, but well, you're at 9+%. It's not too bad, not too shabby.
Something I should have asked you on when looking at all these stocks, do you hold positions in them?
We hold positions in K3 Capital, and we've actually put out a new high yield AIM portfolio to address. We manage money in AIM for inheritance tax planning purposes, and some clients are seeking greater income, and we see there's a growing appetite for income actually. So we have actually launched a higher yield AIM portfolio, which has very little crossover with our standard growth portfolio. And these stocks are, some of them are in that portfolio. K3 Capital is actually in both. We hold that in our growth mandate as well.
Just remind us as well about the IHT business and investing in AIM, because it doesn't apply to all stocks, does it?
No. Businesses have to qualify for business relief purposes. We estimate that circa 66% of AIM qualifies. If you hold the shares for 2 years, they fall out, qualifying AIM shares, they fall outside your estate for inheritance tax planning purpose. So it's pretty attractive. You still have to hold the shares at death. You can trade them as well, so you don't have to hold the same, you don't have to hold premium item forever and a day. You could buy it and sell out of it and buy another one. But it is very attractive as a tax planning tool and as an investment. So you're getting a double benefit. Clearly, this year has been tricky for AIM, but hence we've seen some of these prices come off.
Yeah. Okay. All right, Chris, thanks so much indeed for joining us. Look at the opportunities for dividend income amongst AIM stocks. That's Chris Boxall from Fundamental Asset Management.